Welcome to a very interesting edition of Indianomics. I'm calling it interesting because infrastructure financing is back in the fashion. And why is it back? Because the organization created by the government 2 years ago, the National Bank for Infrastructure and Development, has been able to raise about 28,000 crores. And today they've launched their infrastructure conclave, where it looks like they are finding a lot of interest from commercial banks, from insurance companies, and from the entire ecosystem, even the regulators, in finding money for infrastructure. Joining me to discuss whether financing of infrastructure is really picked up is the chairman of NaBFID, Mr. KV Kamath. Mr. Kamath, thank you very much for joining us. Well, first up, are you enthused? I mean, we went through a lean phase of infrastructure projects not doing well. Do you see a spring in the step?
Yeah, two things have happened. Probably the worst was up to 2015, 2016, and today. For example, the default rates have dropped dramatically. It's now less than 1%. So you have credit-worthy borrowers on the other side of the picture. What was needed was long-term financing for these companies who are coming into the market now for borrowings. So far, banks were meeting there. They did a great job. But there's a natural misfit between a bank financing an infrastructure project and a long-term financial providing. And that is, infrastructure projects by nature are longer. And you have a bank where the average maturity of is 1 year or a little over 1 year. So you're carrying a risk which has to be hedged and difficult to hedge. Enter the long-term fund. The long-term fund has a problem. Where is his source of funds? You remember the DFIs of the 90s? Yes. That was a problem. They didn't have the long-term. But today, with the development of the pension industry, the insurance industry, and even the mutual fund industry, you have a range of providers of funding to this. And we heard from SEBI that now there is a very active bond market in the country. Yeah, more innovation can be done, but there is already an active bond market. So in a way, NaBFID is right in the middle of this. You quoted a number. Now, NaBFID's approvals, I think up to the last month or so, put up 1.5 lakh crores. And I would expect that to significantly increase, almost double over the next year and a half. Now, our capital is just 25,000 crores. If we take our net worth, maybe 30,000 crores. We have raised 30,000 crores. But to meet even what we already approved, we need another 90,000 crores, which will come from the capital market. So we are going to be there in bigger and bigger measure over the next 6 months to a year. And as our book builds, the approval book builds, we will be coming into the debt market even more to a more significant amount, so that we can meet the needs.
I will come to NaBFID's own activities in just a minute. I still want to measure the ecosystem and its interest. For the first, your CEO Rajkiran Rai presented that for the first time we have a large amount of patient capital. If you look at insurance kitty plus pension funds, he pointed out it is 115 lakh crore. Bank deposits is about 210 lakh crore. And infrastructure and pension is growing at 20% nearly, whereas deposits are growing at 11%. So the catch-up will come. Do you see this insurance and pension fund taking interest in infrastructure? Because insurance by its very nature is less risk-prone.
Yeah, see, the idea was that if you can sit with these providers of funding and explain to them the risk profile of the assets that you are financing, then they are satisfied. But imagine that this sitting was happening 15 years back, where you have a very nascent infrastructure industry. It was not private or not public-private, it was still government, so not market tested. Then you have private companies come and market test, and there's a problem, the stranded assets of 2014. And why did that happen? Because a whole lot of problems which you had not anticipated hit you. Acquisition, environmental clearances, and so on, and delays and so on and so forth. All those have now been addressed, as a result of which what was peaked in probably 2016 at 5 or 6%, we're now talking of a little over 1%. Now when I think the patient capital, the owner of patient capital, or where it is resting today, looks at this, he looks at this as a good way to invest. He gets a higher rate of interest than a government security would provide him.
Do you think banks will move into infrastructure like they did when you were at the helm of ICICI, the 2000 to 2010 period? the percentage of the bank's book in infrastructure was significant at that time. In corporate itself, it was significant. Now, 60% is retail for a bank book. Do you see them coming back or overcoming the blues of the previous decade?
2-3 things need to be seen. One is, what is the ideal asset mix for a bank? They are at a one-year end of shorter loans, whether it is typically short cycle working capital loans or retail loans,
yes,
which are typically resettable loans, are probably the ideal product.
Asset liability for match for them.
Then you need to probably round up your portfolio and have 15-20% in other assets which can be hedged. Again, you don't want to go 10 years, 15 years, not 15 years, but even 8 to 10 years,
yes,
with 1 year liability on your, or 1 year assets on your side, and take 1 year liabilities on your side, and take a risk. So you will then run a balanced book, of which a small proportion will be term loans, either to industry, SME, or for infrastructure. So incrementally, the funding for long-term infrastructure projects will have to come from markets, and where will the markets get it is from this patient capital that is lying
from
there,
insurance,
with intermediaries like NaBFID providing the initial approach, and then maybe the ecosystem gets built up as we go along.
Okay. No, I agree with you that, we have this increased pool of insurance and pension, which should provide the long-term money. They are looking for good long-term assets. But even now, although IRDA has given insurance companies permission to go up to 15% infra exposure, they have taken only 9.5%. What is the hesitation?
Transitionary phase. It's a transitionary phase. In no time at all we will say, why not increase it? It's a transitionary phase.
They've not even taken that much in InvITs, actually. You see that only as a recency bias.
These are products which are only 1.5
yes,
years old. And I think it took that much time for the market to adjust. And there is another reason. Bank funding was seen as cheaper till the events in Europe last year.
Okay.
So till then, if you look back, go back and look at the number was even lower. Because if you had bank funding available at almost a government treasury note rate, it was seen as cheaper. But now the situation is corrected. The banks, in a way, are required to price higher, and then things fall in place.
The other positive thing that has happened is government is not crowding out. Until even 2-3 years ago, government was the biggest borrower and banks were forced, we used to call it financial repression. Now fiscal deficit is coming down and there's a huge buyer of government bonds that is landing on our plate because of India's index inclusion. Do you think because of this, there can be more foreign appetite also for infrastructure bonds?
Yeah, indeed. I think what is going to happen is, the first point that you said, the government itself will get freed up because of a simple thing like NHAI putting its assets into an InvIT. And earlier on, NHAI would have had government budgetary support to put money on this one a few years back. But now it has become a self-financing machine. So that part of, say, the 11 lakh crores that we are talking of doesn't exist anymore. Something else could, which is required for an economy going from 4 trillion to 8 trillion. So they will have something interesting to do, but not necessarily what they were doing in the past. So I would simplify it and say anything which was, which was invested through the budgetary process into where strong cash flows exist will slowly get taken out through an InvIT or other structures. And only those that are really required to be funded by government, and traditionally everywhere in the world are funded by government, will get funded through the budgetary program. Okay. So yes, the government's pressure to borrow will go down as you go along.
Yeah, but these index inclusion and the foreign money that comes, 100%. You see them getting interested in non-sovereign.
They will also, where it is non-sovereign, they will also assess risk. But once they assess the risk reward, they will subscribe. Let's look at it another way. These people have been accessing or holding Indian paper when the bond issuances were made in dollars abroad. Yeah, so they are used to holding paper. They are used to the risk, and they have been used to it in a cycle where risk was much higher. Now risk is lower. So now what is the risk that they will have to really contend? is basically the exchange risk. Now, the exchange risk also, my view is, if we continue growing, which I believe we 100% will, at the numbers that everybody is talking about, 7% or up, the rupee should strengthen. Nowhere in the world a growing economy starts a journey and the currency remains where it is or weakens. I'll give you 2 data points. Japan of 1970, inflation was 8%, interest rates were 8%, and Japan of 1995, and exchange rate was 350 to the dollar. 1995, interest rate 1%, inflation 1%, and your exchange rate was 90 or 95 to the dollar. So China, similar story. 2000 as the start, 2015 as the end. The currency has strengthened from 8 to 6 or 6.5. Interest rates have come down 8%, inflation 8% to maybe 2%, and that's the story. So it's now our turn. Inflation has to come down, interest rates have to come down in tandem, and you will grow. And all three happen. And as that happens, the rupee strengthens. And that's where you get the momentum of growth.
This is a headline. This is a headline. Mr. Kamath sees the rupee appreciating, simply going by the historical comparisons of China and Japan.
Otherwise, we will not grow.
Yes.
I will say that if we are going to grow at this rate, the rupee will strengthen. It is not that it has to strengthen. It will strengthen.
It will, yeah, because we are attracting absolutely more money and the macros are getting stronger. Now, I want to digress from infrastructure simply because you have tempted me around another path. Do you see an Indian rating upgrade coming because of this?
See,
I mean, the macros are compelling.
I think, again, we need to sit with the rating agencies and do a heart-to-heart talk, as it were. If you look at the measures or the metrics used, I think the way we talk of certain numbers probably is not the same as in the West. I'll give you a concrete number. Yesterday I was with somebody who is well known globally in the economic world. So he said, I didn't know till yesterday that when we talk of 83% debt to GDP ratio of the government, that includes the provincial debt. He said, in my country, we talk about 43% as
that is only central government debt.
And that's only the central government. The cantons are not included.
Oh, okay.
And if you include the canton, it's probably the same number. So you have a lot of these things which then add up, and that some rating committee, you basically are not getting the due that you ought to get.
No, but considering that fiscal deficit is coming down and growth is, on a steadier footing, plus bond inclusion has already happened. Therefore, I'm asking, is it a logical step?
It's a logical step.
That rating upgrade will come.
It's a logical step. So we need to, I'll put it the other way around. What is the fear that they have that we need to address? This is a country which has never defaulted, has run fiscal and monetary policy in the most, I would say, conservative manner that you could imagine. Is growing at 7%. So this,
do you think we'll get a rating upgrade in a year? Is that?
I would be optimistic that we should get that in a year. And again, we will need to make the case very strongly.
Well, let me ask you to hold your thoughts, sir. We have to take a break on that note. But thereafter, I want to ask Mr. Kamath, what went wrong with our previous experiments? We had development financial institutions, ICICI, IDBI, IFCI. Mr. Kamath himself was head of one of them. What went wrong over there? Those questions after this short commercial break. Welcome back to this very special chat on Indianomics with Mr. KV Kamath, now chairman of NaBFID. Okay, now let me come back to NaBFID and its role. The moment this institution was set up, my mind went back to the DFI, the one that you took over in 1996, ICICI. We started off with development financial institutions to finance infrastructure. That failed. ICICI became a bank, IDBI also became a bank, IFCI is meandering. What went wrong, and have we set it right?
It's very simple what went wrong. Very simply put, our liability side was basically either monies that we raised from the World Bank or like institutions and long-term paper which we issued, bonds which we issued, which were government guaranteed and were eligible as SLR securities.
Yes.
So that was our funding mix. In the 90s, that was completely withdrawn. We could continue to borrow from the World Bank, but rupee access was withdrawn.
Tax concessions were withdrawn, SLR
so there is no way that we could continue to, and we quickly saw it, and we said we are repositioning ourselves as a retail bank. We will first access bonds. We actually access rupee bonds. And then we said, of course, as the bank gained size, we built momentum. What has changed today? Today, the patient capital that is lying there that you mentioned, that is there available. And they now have confidence to look at an institution which can borrow, an intermediate, and lend to people who are in need of this funding.
Okay. Well, one reason why Mr. Rajkan and I point, chapter and verse how default rates have come down, risk defaults have come down in infrastructure assets. But the point is, that is because we had a rush of investment, infrastructure investment from 2000 to, say, 2004 to 2010, and that some of it went bad in the last decade. Now banks' books are delevered. But if there is another period of optimism, the problem can come back. Do you think, see, for instance, IBC is still not giving us assets back. I mean, their ability to get back is actually fallen from 42 to about 23 or something. Likewise, the arbitration by the government takes a very long time. Will all this,
let me put it
lead to pessimism?
I don't want to go through that process. It's a legal process. I think there's a learning curve there. But despite that, a whole lot of things are resolved. But let me go to something more concrete. You imagine you are in 2010, 11, 12, or in the earlier periods, and the shortages that we went through, whether it was power, there was no power, whether it was road access, there was no road access. Every single thing was in, because we could not afford it, and we could not put it in. And that's where we put things in to build. And these investments hit another problem hit them. Land acquisition, environmental rights, and so on and so forth. Today, all those have been cleaned up. Second is, investment is happening. You see, we are not reckoning that it is happening. And I will explain how do I say it's happening. I'll ask the same question. What are the shortages that you see today as you go out?
Power.
Power, actually is keeping pace. You are not seeing the sort of blackouts that we had in the past. And power investment is actually migrating from thermal to green to, and I think it will evolve and it will be in our favor. New technologies that will come in power are not going to be fossil dependent. So it's going to be with us. So we are looking at ports, airports, rail, even rail. Capacity is increasing. So roads, everywhere you are seeing increase in capacity. Yeah, we could have more, yes. We need to have more to be, to represent an 8 trillion economy, 100% yes.
But most of the investment is coming from government.
It's again, let's look at it. Where is the investment in ports coming? Private sector. Where is investment in airports coming? Private sector. Where is investment in telecom coming? Private sector. Where is investment in power coming? Probably, I don't have the numbers, but probably 75% from private sector. So the government's role really is in those industries which are not financially viable in any country.
Let me put the same question in another way. What is your sense in terms of what you want from the regulator? My own sense is that the IBC process could be better. The lower levels, NCLT, NCLAT, the infrastructure could be better, human infrastructure.
Yeah, if you ask me,
likewise, arbitration. What is your ask?
If you ask me about the regulators that we deal with, whether it is RBI, SEBI, or the insurance regulator, I don't think I have any ask, because they are come up to a level where they are held up now as good examples by global regulatory bodies. So I don't think there is any ask. Yeah, the resolution process in almost every area, I think, and they themselves talk about it, needs to be speeded up. So to me, that is what is probably
an agenda. The legal ask, the resolution.
Which everybody acknowledges that resolution and speeding up, I think, is what is required.
But do you think then insurance and pension, which is the capital that is waiting for long-term assets will come unless this is resolved?
No,
or do you think they will continue to hesitate?
If the default rates were what they were, of course they won't come. But if the default rates are one, they will factor it into the base case and make their assessments and come.
Okay. Now let me come back to NaBFID. What do you see? Will you all be actually writing out checks for infrastructure companies, or will you all do more in terms of credit enhancement, guarantees, partial guarantees? What role do you see?
We will do both. The charter is very clear. The charter has a lending role and developmental role. By developmental role, I would look at development of the framework to do. So what you mentioned all falls under those, that category. And of course, there is within that you then, activate the bond market to a much higher level. So that's was seen as a role. So to me, it's a continuum. You are on lending on some, and as the customer has a need to credit enhance, we will be there, and we will move on to other products.
So you will be doing both, actually writing the check for infrastructure,
we will do
as well as. Do you also see yourself doing credit default swaps, even derivative products?
Indeed. See, because there is no bar on what we could do.
Immediate hiccup for infrastructure builders and for infrastructure financiers like banks is that the Reserve Bank is coming with higher provisioning requirement.
Yeah.
There is a draft set of rules, and provisioning is going to rise from 0.4% for a standard asset to 5% for a standard asset if it is infrastructure. Won't that increase the cost?
See, we will have to understand how it works out. I think there are representations being made, so I don't want to preempt the whole thing. How do you want the provision to be made? What route do you take? So I won't go too much into it, because these are delicate things that need to be discussed. And what is the regulator's final thing? Ultimately, if the regulator is doing something, it is after a lot of thought, and it is for a systemic good.
Okay, now let me come to the question that we always ask you. How do you see the growth prospects? There is some discussion. Most people are veering around to the view that the India growth story is more a 6.5% to 7%. Even the economic survey gives that kind of a view, of course, for the nearer term. Are you getting a sense we can break the 7% barrier?
Yeah, I look at it this way. 7, I think, is a given because of the unfinished agenda. See, we are not a country where we have to build bridges to nowhere. We have got bridges to build for a purpose, infrastructure to build for a purpose, and that's.
You mean unlike China?
Unlike Japan, I'm taking of the whole. So we have a 20-year horizon to grow, and we will at least 25 years. I think it's probably the right number, but at least 20 years for sure. So over that period, we will invest for what is truly needed. So there is no frivolous lending here. So I'm comfortable that things will happen.
That it will be a 7+
so
story.
That drives growth. That's one key part of your growth driver is the infrastructure. Then you take the housing agenda, unfinished agenda, for housing millions of people, hundreds of millions of people.
The need is there, of course.
The need is there, and as the momentum
it is the ability to pay that
the virtuous cycle comes in.
Yes.
So as
so you think 7% is something we should?
Yeah, and then if you look at it, actually,
what's your number for the next 10 years?
All of us will have to look at 7% plus inflation minus depreciation.
Okay.
I think we have to now approach it on that basis. And if I say that 7% plus 4% minus, say, depreciation of the rupee, if we can contain, then you are looking at 11% growth. So I think we need to look at this in a calibrated way, and that factor that we're using to say how the depreciated rupee will have this impact, that should be, actually we should say that that's going to go away. And then we will have
then we are
7% plus,
sure.
yes.
That's very hopeful. It's always the case, Mr. Kamath, when I speak to you, you come back optimistic. Thank you very much for sparing time with us. So that's the word from the big man. 7% is a given. That's not counting productivity gains that will come for us. But I think for me, the bigger takeaway is that it looks like we're in for some appreciation of the currency hereafter. That's it on this special edition of Indianomics. Thanks for watching.